Thanks for clicking. The Bank of Canada should stop raising interest rates. As the inflation data shows, without the rate hikes, we're almost back to 2.5% inflation. This was the message coming out of a Financial Post article in the immediate aftermath of the release of Canada's 3.4% inflation rate. Following the release of the CPI data, I had made the lighthearted joke that we would be seeing this argument coming from the usual suspects, meaning realtors, but instead it came from Ted Rexteffen, a regular contributor to the Financial Post. Rexteffen, I'm probably butchering that, makes the argument that since inflation is sitting at 2.5% if we take out mortgage costs, that the Bank of Canada can and should stop raising interest rates. After all, suggesting that the Bank of Canada raise rates in order to fight inflation when it's the rate hikes that are causing inflation is like suggesting that someone with high blood sugar should eat a sugar cube to bring down their sugar level.
That's just a straight shooter with upper management written all over.
Yet, a closer look at the data, or even a basic read of the Bank of Canada's policy statements, shows that the situation may very well be more complicated. So what I want to do today is go over Rexteffen's article saying that the Bank of Canada should stop raising rates, take a look at why the Bank of Canada probably doesn't see it that way, and then discuss what to look for next. Speaking of next, as we'll see today, the Bank of Canada is a forward-looking institution, or supposed to be, and is set to release its Business Outlook Survey and its Canadian Survey of Consumer Expectations, both of which will no doubt have a big impact on whether or not it raises rates going forward. We'll obviously have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this article. Onto the article. The article starts off by pointing out that mortgage interest costs have risen by 29.9% since this point in time last year, noting, in what I think was an attempt at sarcasm, that when the Bank of Canada raises rates, shockingly, mortgage costs go up as well.
Devilishly clever.
Rexteffen makes the case that since higher interest rates are used to push down the CPI, but in this case are pushing it up, that it makes sense to exclude them. Further, questions Rexteffen, if higher interest rates have a lagging impact and the CPI is already sitting at 2.5%, then doesn't this suggest that we are done taming inflation vis-a-vis interest rate hikes?
I got a lot of big ideas too, but...
So Rexteffen is saying that because it takes a while, sometimes 12 to 18 months, for interest rates to have their full effect on the CPI, then with inflation sitting at 2.5%, we should see it come down in short order as that 4.5% worth of rate hikes that we've seen over the past 17 months continues to kick in. Now, Rexteffen notes that if you do focus on salary increases or food price increases, then one can make the case that further rate hikes are needed. But Rexteffen simply doesn't buy it.
Well, I'm sold.
The article notes that food prices and service prices are already included in the CPI and that we're only removing the only item that we know will go up if the Bank of Canada raises rates. So we have the Financial Post and Rexteffen making the case that the Bank of Canada doesn't need to raise interest rates any further, that it should pause, as the interest rates are doing the majority of the inflation causing. Yet, when we look at the forward-looking data and what the Bank of Canada has had to say, it's not clear that the situation isn't a little bit more nuanced than we've got this kicked, sit back and wait. Instead, what the central banks tend to do, to one degree of success or another, is look to forward-looking indicators. In fact, as was stated just last month in its interest rate policy announcement, the Bank of Canada will be looking at inflation expectations, wage growth, and corporate pricing behavior when deciding whether or not to raise rates going forward. Stephen Tapp, chief economist at the Canadian Chamber of Commerce, said that on these fronts, there is growing evidence that inflation has not gone away, noting that although inflation is slowing, 30% of companies still plan to raise prices. Indeed, according to the Chamber's most recent survey, cost and labor remain the biggest challenges to businesses going forward. So, Canadian businesses, for now at least, expect costs to remain high. They expect labor costs to remain high. They expect input costs to remain high. And of course, we'll be passing those costs off to the consumer.
I talked to them a million times. They don't listen.
And Governor Macklem talked about this point last month.
The labor market needs to rebalance. Corporate pricing behavior needs to normalize. And near-term inflation expectations need to come down further.
So we have Canadian business predicting increased costs going forward. We have the Bank of Canada looking to increase costs right now. And that's not even to mention the growing number of wage demands coming out of Canadian workers who are trying to recoup their lost buying power that they've seen over the past few years. So while inflation might be sitting at 2.5% minus interest costs For now, the Bank of Canada is looking at the forward-looking indicators, looking at these indicators and trying to get ahead of them as best that it can.
It's long overdue.
Monetary policy, as Rex Staffen even notes, works with a lag, but so too does inflation. When inflation is allowed to take hold, processes get set into motion, which aren't that easy to stop. Wage price spirals, whereas the higher cost of goods lead to a higher cost of wage, which lead to a higher cost of goods, etc., tend to take hold and are difficult to break. So Rex Staffen, and I'm sure more to come as time goes on, are making the point that because the CPI is back down to 2.5% if we take out mortgage interest costs, if we take out the effects of the higher cost of borrowing, that the Bank of Canada should pause on rate hikes. However, there are a lot of other processes at work which are pushing up inflation. Not now, but 3, 6, 9, 12 months from now. And the Bank of Canada, the central banks, not wanting to have to go even higher for longer, are more likely than not to try to get ahead of those processes, to try to get ahead of the potential for a wage price spiral before it even has a chance to take hold. While the CPI coming down is good news, while the CPI sitting at 2.5 minus mortgage interest cost is definitely good news, to look only to the mortgage interest cost is a little simplistic. It's narrow and it doesn't capture the whole picture. With that said, as mentioned, we do have that Business Outlook survey coming out tomorrow, as well as the Canadian Survey of Consumer Expectations, both of which the Bank of Canada will no doubt be looking to when it makes its decision on its rate hiking path. We'll obviously have updates out on both on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.